A warm welcome to this short clip on SageOne Investment Managers. The word Sage in our company name reflects our core principles of being wise and being virtuous. I take this opportunity to introduce you to our organization, our journey, and most important, our people. Headquartered in Pune, SageOne Investments was founded by our Chief Investment Officer, Samit Vartak. The foundation was on the premise of sharing his skills of identifying good businesses with clients at large. His endeavor was to generate superior wealth for his clients and do exactly the same for them what he did for himself and his family and friends during the period of 2008 to 2012. Samit shares a very interesting background both in terms of academics and his professional career. He pursued his engineering from Mumbai University and then went on to study his MBA in US. After completion of his MBA, he did his CFA. Samit worked in various consulting firms like Deloitte and EY in the areas of strategic consulting, valuations. 2006, he came back to India and started his career in private equity. This unique combination and background of working in setups like strategic consulting, valuations, and private equity honed his skills and ability for him to identify good businesses, identify traits of a quality business.
Okay, so let me cover SageOne strategy. What I want to do is start right from the beginning, why we do what we do, and then cover how we do it, as well as cover the risks involved in the strategy and the nitty-gritties of how we construct the portfolio. Right? So if you look at the opportunity, where is the opportunity? Right? India is about a $3 trillion market cap economy. This is as of today. Out of which, if you look at the fund management industry between the FIIs and the DIIs, it's about $1 trillion. Right? And if you look at that $1 trillion, 80% of that, meaning about 800 billion, is all invested in the top 100 stocks. Right? And that's where the inefficiencies are almost missing. That's where all the crowd is. Right? But if you look at the remainder of the next maybe 600-700 companies, which are good enough, where there is reasonable liquidity, where a fund management industry can take some stake in it, that only manages about 20% of the overall AUM. So 100 managing 80% and the remainder of probably 700-800 just 20% of the, and that's where the inefficiencies are. That's where there is not much coverage in the brokerage houses, and hence as a fund house, if you have the ability to go on ground and do your own research, there is significant alpha that can be captured because of the inefficiencies in that space. Right? So when we started, our goal was, I started personally, and my personal goal was always that I should be able to double my portfolio in 3 to 4 years. That is the goal. I think the only way you can consistently do it is by finding companies where the earnings growth is similar to that, meaning that earnings have to double in the next 3 to 4 years. So that is the core philosophy, right? And it's all about, that is the space where you find that. So it's very difficult to find that in the large cap space, and hence SageOne never started as a mid cap or a small cap kind of fund manager. I mean, one fund manager has to be has to be flexible, but unfortunately, when you look for high growth companies and high returns, it's very difficult to find that in the large cap, because large caps make up most of the GDP of India, and if you look at the nominal GDP of India, it's generally around 12 to 13%, and it's very difficult for earnings to diverge too much from that, whereas we are looking for double of that growth rate. So that is where our universe is, and that is how we started. Right? Now, what is it that enables us to find companies where the earnings will grow at that rate? We are looking at 20 to 25% kind of an earnings growth rate. Right? I think there are a few things that one needs to. There is no simple way of doing it. There is no easy way out. It's all about hard work. How much groundwork do you do in evaluating that business, and that's what we generally try to do. We don't just go and visit the plant or just go and talk to the management of the company, but more importantly, we like to interact with the supply chain, the right participant in the supply chain, whether it's the distributor or the vendor, also the competitors, because that's where you get a lot of insights which managements may hide from you, right? And see, when you're looking for double the growth rate of the economy, generally it comes not just from the industry growth, but it comes from market share gain. And one of the key in market share gain is what are the competitive advantages of a company against the competition, right? So you can't evaluate a business opportunity in isolation. You have to evaluate the entire competitive environment as well as the entire industry, and pick the company where you think though they have the sustainable competitive advantages, and bet on that company. But it's all about how in depth do you understand that company. There is once you have that knowledge, one, you can have some ability to predict the growth going forward, as well as you can evaluate the risks, because in this space, when you are going after small and mid cap companies, tracking the risk is one of the most important factor, because exits become very important. You can't just base it on buy and forget kind of investment style, and I don't think India is made for that. If you are targeting 20% plus growth, yes, if you are targeting 12, 13, 14% growth, which is consistent with the GDP growth or nominal GDP growth of India, then it's practical to buy and forget and stay invested in few stocks that will grow with the economy. But when you're targeting double of that growth, you have to be a very proactive investors, and we are proactive investors. The team makes a lot of difference. All of us are extremely passionate about investments. This is what we think 24/7. This is what excites us. The groundwork, understanding the businesses is what keeps us going. And I think how the team works together, how they contribute to each other, also makes a lot of difference in our understanding of businesses. Because as a lone person, it's very difficult to understand and think from all perspectives. It's the teamwork which provides different perspective of looking at risks and evaluating the business, and that knowledge contribution, I think, is very important in this space. And we have done that pretty successfully over the last 10 years since I started SageOne in 2012. Right, the portfolio company's earnings growth has been about 30% per year, and that's been the key driver behind the returns. The annualized returns of about 30% in the last 10 years. Right? And that is the key. And another key is how often do you get it right and how often do you get it wrong. In the last 10 years, in terms of the number of companies that we have invested, have been about 80, out of which 50 companies have delivered more than 25% annualized returns. So those are the number of almost 2/3 of the companies we have got it right, not only in terms of positive returns, but in terms of beating what we look for, right? And about 15% of the companies is where we have got it wrong, meaning that we exited in losses. Right? But fortunately for us, we have taken generally quick losses, and our exits have been more than efficient. So whenever we have had losses, it has been minimal, right? And what are the risks in this strategy, right? So I think it's very important to understand the risks. Equities, I've seen equities returning most of returns in a very short, concentrated period, right? So if you entered into 1992, during the Harshad Mehta peak, right? Even in 2002 and 2003, you had the same level of Sensex. That means for 10 years or 11 years, the market had gone nowhere. In between, there were rallies, there were crashes, right? So there was also a dot-com boom in between, right? But then after 2003 to 2007 was a great market for India. That's where, the Nifty Sensex probably went up 6-7x, and the mid cap and small caps went way, probably 11 or 12 times, right? But then again, after it peaked in 2008, until 2014, the returns were almost flat. So you spent 6 years without really any returns, right? So, and same thing keeps on repeating. Then we had a good market from 2014 to 17. Again, it went flat. So there are risks to the market. I feel in the mid and small cap space, your entry points are extremely important, right? Because depending on if you enter at the peak, you can have many years of no returns, and that is possible. And so having a conservative view on entry points is important in the market. For example, in 1992, the entry price to book was 9 or 10 times, right? You spent 10 years no returns. In 2008, the entry P multiple was 6.5. Price to book was 6.5, and you spent 6 years without any returns. Most often, the price to book is more predictive of what your long-term returns are going to be. So, irrespective of whether anyone says that there is no point in timing the market, there is some prudence, especially in India and especially in this this space, to be careful. And hence, we also are not running after AUM all the time. We have had period in 2017 when we were uncomfortable with the market, that we do not take money at that time. So we had a year when we had stopped taking money. Again, in last year 2021, we stopped taking money in the small cap for 6 months. So we are not running after AUM, because I think one of the biggest drag and disappointment for the investor is either you take the money at the wrong time or you force the investor to come in at the wrong time. And secondly, the size that you manage, right? Because size is because of the business that a fund manager runs. I think it creates a big drag in terms of returns. And there is a huge conflict between the business and the investor interest. So we are extremely cautious. Our thumb rule that we use is that we do not want to manage more than 1% of our portfolio market cap. Meaning that if we have the average market cap in our small cap strategy of about 5,000 crores today, right? And we can go up to 20 stocks. Between all the 20 stocks, we have a 1 lakh crore market cap. So we don't want to manage more than 1,000 crores in that strategy. Same thing is with the core portfolio. The size there probably is 3.5 or 4x of what we manage in the small cap, because the companies tend to be of higher size. So limiting the AUM, it's one of the most important factor in sustaining the performance, and that's where we are not hungry for AUM. We will try to manage with the thumb rule in mind. We don't even want to reach that 1% level. Probably want to stop when we reach probably 0.8% kind of a level, right? In terms of portfolios, right? So we have two key portfolios. One is the small cap, which focuses on companies which are below $1 billion market cap and maybe up to 2,000 crores market. So between say 8,000 crores market cap to 2,000 crores market cap. And the core portfolio focuses on companies which are above $1 billion market cap, mostly in companies which are 8,000 crores to maybe 60,000 crores market cap. That's where each of the portfolios typically would have minimum 12 stocks and maximum 20 stocks, right? And the reason for that is there has to be a balance between diversifying just for sake of reducing risk, as well as diluting the number of companies you have in the portfolio. This generally we have 16 stocks in the portfolio. That's a good balance for us, because at 16 stocks, if we have done a good job of diversification, typically you can diversify away 95% of your systemic risk, right? Beyond that, by adding more and more stocks, you are not really reducing the diversification, or reducing the risk of concentration, right? So that 16 stocks is the right number, as well as it's easier for us to deeply track these companies, 16 companies. Otherwise, if we invest in 40 companies, it becomes more and more difficult to track not only the businesses closely, but the risks that emerge in those businesses. right? So we maintain that 16 stock kind of an average portfolio number of companies. The allocation to each stock ranges from 4% to 10% at entry point. I mean, we let it run if the portfolio or the stock does well, right? So that's more in terms of portfolio structuring, and hopefully with that you would have gotten a pretty reasonable understanding of what we do, why we do it, and how we do it. But again, bottom line is there is no shortcut to investing. There has to be hard work in finding companies where you evaluate the long-term structural nature of the businesses. It's easier to understand the demand side, but I think what we focus on is the supply side. For example, everyone knows that there is going to be demand on the infrastructure side, or ethanol side. There are many structural long-term demand stories, right? But the key is how many competitors will emerge in that businesses. There are certain businesses, if the supply side increases more than the demand side, as an investor you make no money. So we try to focus a lot on the supply side, and where we want to invest in companies where it's almost impossible for newer entrants to come in, and the entire growth is captured by the existing few players. And that's where we have mostly find our multi-baggers. And one other thing I want to point out, because we are operating in the small and mid-cap space, people do perceive this space as a risky space, right? But if you look at our history in terms of how much have we gained when the markets are in a bull run, right? So if the markets go up by 100%, we will go up by 109%. So in a bull run, we do as good as the markets, maybe a little better than that, right? But our alpha gets added when there is a downside in the market. So when the markets are down or in a bear market, our downside beta is 0.65, meaning that if the markets go down by 10%, we will go down by 6.5%. I think that's where we generate alpha. And hence, if you look at our long-term periods where we have made no money, typically over a 3 to 4 year period, most of the times the returns are positive. And in a 5-year time period, typically our minimum average returns have been in at least high teens. Of course, if you enter at the low in terms of P multiples or the valuation multiples and exit at the top, the returns could be as high as 40%, annualized, right? So this is how we do it. Really appreciate you taking the time and listening to this, and let us know if there are any further questions. We would be happy to answer that. Thank you.